Hello and welcome to the Consumer VC, where we're going to be diving into the world of venture capital and consumer-facing startups. I'm your host, Mike Gelb, and over a series of interviews, we're going to learn about how early-stage B2C startups raise money and look into the inner workings of venture capital. If you're interested in consumer-facing startups, thinking of starting a B2C startup or have your own B2C startup, or interested in venture capital, you've come to the right place. Feel free to also follow us behind the scenes on Twitter at Mike Gelb and for show updates at Consumer VC. Our guest today is Amit Mukherjee. Amit is a partner at New Enterprise Associates, also known as NEA, one of the premier and global venture capital firms that invest in all stages. Amit focuses on investing in consumer technology. He is the board observer for Casper, Masterclass, Brandless, and the Players Tribune, and was previously a board observer for Jet.com. Amit has led a number of seed stage investments for NEA, including Aquabite, Cake, Holloway, Yumi, and PumpUp. It was an absolute pleasure having Amit, and I cannot wait for you all to listen to this one. So without further ado, here's Amit. Well, Amit, thank you so much for coming on the show. I really appreciate it.
Happy to be here. Thanks a lot for having me.
What attracted you to head into venture capital and specialize in consumer?
I think that's there's like two elements to that. The first is, growing up in the heart of Silicon Valley, was born in Stanford, grew up in Mountain View, and I'm the son of two immigrants. And my father worked in a variety of tech companies growing up, and basically all of our family's friends worked in tech as well. And so I was just constantly hearing about these companies and how they're doing and just what people talked about in their free time. A lot like right now when we talk about work and what's going on with different tech companies when we're at a bar or at dinner and whatnot. And so I always just assumed that I would end up in the technology field in some way. And being in Silicon Valley, I was exposed to the different elements of it much earlier than other people were, and I really feel very privileged because of that. And so I just kind of came across a video of John Doerr from Kleiner Perkins when I was 18 years old, talking about the world and the future, and I was just so inspired. I sort of said, "Hey, let me try to figure out a way to do this as quickly as possible." And then in terms of focusing on consumer, sort of had a lens on how are we as individuals behaving, and I always thought that was funny to analyze. So growing up, I was using Napster a lot. I was on AOL Instant Messenger all the time, and we always talk about, oh, it's so funny. Why did this person put this in their profile, or why did someone put this in their away message? And just kind of thinking about those things from an early age, that transcended into when I was in college, spending time on Twitter and with a bunch of startups and just kind of thinking they were cool. When I started at JP Morgan, having that interest just personally led me to focusing on consumer companies, consumer internet companies when I was there.
That's cool. So from a young age, it seems like you weren't only just interested in trying out these new technologies and spending a lot of time on them, but also noticing how others are actually using these products. When an entrepreneur pitches their product to you, how do you know if there's a real pain point when you're conducting due diligence and that a valuable product?
I think we try to triangulate with a lot of different data points to assess product market fit and pain. One is just instinct and gut. When we hear the story, when we hear what they're addressing, we try to think for ourselves, how big of a pain point does that feel like, and does that align with other data points we're seeing in terms of economic trends, personal experiences, et cetera. And then there's obviously more concrete data points too, and it depends on the category within consumer. But you can look at NPS score, you can look at just how sales are doing and how many of them are happening organically. You can think of how many referrals a product has. We could think of it's an app, the engagement, time spent, number of times opened. There's a lot of different data points for whatever a product is. And I think very quickly you're able to triangulate on how big of a pain point it feels like and how much of that pain is being relieved.
So you have two companies in the same space you're looking at. There's similar stages. And so what do you look for to differentiate when neither have a long history of validation tied to financial performance?
Yeah, I think if you're looking at two companies in the same space, we're going to really think about three different elements. The first, it's almost always the first, even when we're dealing with much later stage companies, is the founder. Is it a founder who's thoughtful? Is that founder a good storyteller? Is it someone who's honest? Is it someone who's self-aware and has the ability to evolve? Is it someone who has high integrity? Those traits I listed off, we actually think about each of those traits individually and try to dive deep into understanding if the founder has them. I think the second is really business model. A lot of times there's different ways to attack the same end market. You could create Instacart or you could create Blue Apron. And we're going to think about just from sort of a theoretical business model perspective, which of those feels like it is the most capital efficient, which has the deepest, widest moats or barriers to entry, and is the most differentiated, and just generally talk through, hey, how do we think that this business model is going to play out over the next 5 or 10 years? And the final is obviously traction. If the traction is different, it's very easy to tell. But I think when we're investing, thinking we're going to hold or be an investor in that company for 7 to 10 years, we typically think more about those former things than the latter thing, because early traction is usually still a fraction of the ultimate scale a company needs to achieve. So we try to look for business physics and also founder qualities that can be enduring.
And speaking about founders, experienced founders versus and serial entrepreneurs versus first-time founders, what are the kind of barriers do first-time founders in consumer need to meet in your eyes before you consider them?
It comes back to those same qualities that we're looking for in founders. We don't say, hey, experience is something we're going to put a premium weight on. It's something we consider, and it usually dramatically changes our interactions with the founder. But it comes back to storytelling ability, thoughtfulness, aggressiveness, integrity, and self-awareness. And we'll sort of try to think about those different traits and if a person has them. And we'll also look at what they did before founding the company, why they're founding it, and just kind of get a sense from the conversation, how they're asking questions, how willing are they to learn, what are the types of things they're thinking about. So there's a lot of ways that we would assess a founder that would be much more important than a box you can check on, former founder or previously founded a company, et cetera.
That makes a lot of sense. I know that round sizes have increased quite dramatically over the past few years with huge funds going into venture capital. And now we have pre-seed micro funds. How has this influenced you as an investor?
Yeah, what's happened at the seed stage in particular, I think is amazing and dynamic. I think over the last few years, when I entered venture capital, there probably weren't more than 100 seed funds in existence. And then I heard a stat a couple years ago that there were 600 first-time funds being raised at the seed stage just in that year alone. So we've seen a close to a 10x increase in the number of institutional funds at the seed stage. We've seen a bifurcation, as you mentioned, to pre-seed, seed, maybe mango seed, or sort of a small Series A. And then we've also seen valuations increase pretty dramatically from 4 pre and 5 pre back in 2012 to you're seeing a lot of deals getting done at well above 10 pre now. So a very big shift there as well. What does it mean for me? I'd say that in terms of my evolution as an investor, it doesn't sort of parallel track the market exactly. As NEA has matured and investing in seed companies, and as we've thought about what strategy makes sense, we've basically said, hey, investing in these party rounds, putting in $500,000 in a seed round, it doesn't really feel great on either side. We usually don't have the same conviction as if we were leading a round and really working with a company. And as a result, the founders say, hey, I didn't really get a lot from NEA after a year. And so, we think that there's always a risk of that. We think we mitigate that risk when we're taking higher conviction bets at the seed stage. So what we've done is we've said, hey, when we invest at the seed stage, we really want to lead the deal, take a significant ownership percentage, and really work with the company. So we treat it just like a Series A investment rather than say, oh, hey, let's throw in a little bit of money and see what happens. And we think that aligns us with founders better, keeps us more focused, and allows us to make a bigger impact. So that's kind of the shift that I've made here at NEA, and that others here at NEA have made. I think it's not so much a response to changes in the market as much as it is just an evolution of our investing strategy.
Yeah, I mean, sometimes I feel like it's just different names, but you're still, investing similar amounts, but it's just become different names in terms of pre-seed and seed rather than what would be, a few years ago, just a Series A called. So
Totally. I was at an event where a founder asked me, like, hey, can I call this Series A1, Series A2, my Series A? And it's like, look, investors are going to understand that really quickly. They're going to see the dollars you raised, what you did with those dollars, and I think we'll be able to make a pretty fair assessment pretty quickly, and the names will sort of fade in the background. But yeah, I definitely agree with that sentiment that the names have changed a little bit, but similar amounts of risk for similar amounts of capital have been taking place for for decades here in Silicon Valley.
Right, absolutely. So how do you feel about cold introductions versus warm introductions when founders reach out to VCs? I know this is quite a contentious issue a little bit on Twitter.
Yeah, I have no problem with a founder reaching out directly, and I do spend a lot of time on Twitter, and I think a DM there where you start a conversation based on comment I made, etc., is always well received, especially if the founder has put some thought into why they're reaching out to me specifically. If they look at a company I've invested in or something I've written and say, hey, that really resonates with what I'm trying to build, it would be great to have a conversation with someone who's thoughtful like that. So I've got no problem with it. But to be honest, at the same time, if I look at the investments I've been involved with, very few have come through those, very few that we've ended up investing in have come through those channels. And I think the reason why is because most founders who are successful build up a great advisory network for themselves to learn what it takes to be a founder. And usually those advisory networks would advise them to approach venture capitalists in a certain way. So it's not that we won't consider cold intros, but most people who have set themselves up for success learn that a warm intro is helpful in being successful, which is, I think, part of the reason, or it's a compounding effect to why you see warm intros resulting in investments so frequently. If I had to give one piece of advice to founders when they're starting, it's to create an advisory board of themselves of 5 other venture-backed founders. I think what we see a lot is that they'll find a business school professor or someone who's successful in business that they know, but those people are advising them a certain way and are well-intentioned, but don't really understand the full Silicon Valley playbook. And if you get 5 founders to believe in you, usually they will help connect you to the right people. They'll advise you the right way. And as part of that, they'll advise you on how to fundraise successfully. So I think that's where the sort of correlation comes into play.
Right. That's actually great advice. So I imagine also that time allocation across your portfolio is probably rather difficult since we all have a limited amount of time. So do you tend to spend more of your time focused on the startups that is receiving traction, that are deemed quote unquote maybe the winners, or those that are more struggling and maybe need further greater help in your portfolio?
We spend a lot of time with both, honestly. I think the ebbs and flows of how much time we engage is usually not directly correlated with how the company is performing. A lot of times there are specific things we can help with, whether it's a hire or a business model shift, or helping set a financial budget for a year. And so a lot of the ebbs and flows will correlate with that. And I'm early enough in my career where I'm spending a lot of time with all the companies that I'm on the board of, and I think it's going to be a while until, I've got so many board seats that I have to less than generous with my time to some of my companies. So I haven't personally run into that challenge of time allocation as much. And I try to sort of figure out a cadence with all my companies that the founders are happy with. But it's obviously something you gotta manage and think about.
And what's one thing that you would change about venture capital?
There's a bunch of things that I would change. It's a really interesting question. From a diversity angle, I do think that venture capital firms would benefit from being much more diverse. And I think that with diversity, a lot of the processes that get calcified when the firm could change very organically. And when I mean diversity, I think there's been a real focus on increasing gender diversity in firms, but I think we also have a need to increase minority representation and the representation of people who come from different economic backgrounds. And all those things are really important. I think both founders and investors can feel a little bit burned in transactional conversations where you're sitting across from the table, and I think both founders and investors can feel like the other person only has like dollar signs in their eyes. And I think the more that we're able to be curated about the conversations we have, and that there's mutual respect on both sides, I think the healthier the ecosystem is. And so those are a couple things that come to mind.
I think those are some great points, and certainly are some things that the venture capital world has been heavily criticized for. Now, I know you've been part of some of the more high-profile D2C investments. How do you think about D2C in these current times with the rising customer acquisition costs through online channels?
Yeah, I mean, I think you hit the nail on the head. I think that's the challenge that every D2C investor deals with. I think the reality is that almost every consumer brand needs to be reinvented for millennial and Gen Z values. And so I think we will see that happen. And any new brand that arises is very likely to start internet first. I think it's just logical to have that level of market exposure versus, starting in a retail store. So I think a lot of money and successful companies are going to be created, but I think understanding the risk reward of the category specifically, I think the way that people think about financing these companies will change a bit. So, $1 billion valuation because we saw really quick growth, probably not the right sort of framework for thinking about how to invest in these companies, given how we know that they scale. But I do think the category will be successful, and there will be a lot of winners for a long time.
And I know one of the buzzwords is online to offline developing. Do you think that digitally native brands are going to get offline and make stores more quickly than we've seen in the past?
Absolutely. I think if you look at a lot of the leading D2C brands, many of which were now started 6 or 7 years ago, I think they're moving aggressively into retail, and partially because marketing online gets to be so expensive, they see the return on the investment of creating retail stores to be just as high, if not higher, attracting new customer and increase awareness, which may convert online as well. So I think that's going to become a proven strategy very quickly, and we're going to see that proliferate across many brands over the next 3 or 4 years.
Cool. What trends in consumer are you most excited and focused on?
So we've been thinking a lot about Gen Z and how behaviors in Gen Z are different from millennials. We've been doing primary research, spending time in TikTok, Visco, and a number of apps to just try to understand what people are talking about, thinking about. We're also doing interviews with teenagers in high school to just get a sense of what their values are and how those might differ from the values of the generation beforehand. And, I think you do see a much more activist mentality amongst Gen Z versus the millennial individual. And that's being reflected already in the types of companies and products that they support. You're also seeing, and I think this is the most interesting trend, much higher skepticism of traditional education and a much deeper inclination to do things that are entrepreneurial early on, and also more creative. And I think as those behaviors manifest themselves, very big institutions with a lot of economic power behind them like traditional college, et cetera, I think is going to give way to lots of varied forms of people developing themselves, and they'll develop in very different ways. So I think we're going to see industries we've never thought of before, patterns of success that are extremely different than the past. And I think a lot of new, very big companies are going to be created in response to how behaviorally different Gen Z is from the generations before.
Now, for Gen Z and this do-it-yourself entrepreneurial spirit that seems like you're alluding to in terms of in terms of education, do you think that part of the behavior was caused by the past 10 years or so the economy has performed so well?
That's actually an interesting thought, and there's probably some truth to that. And so I would sort of say there are probably three factors that are all incorporated. The first is most Gen Z children grew up with parents who are recovering from the economic crisis of '09. So you look at a lot of people who feel like they were failed by traditional institutions in America. I think there's reasons for Gen Z to be skeptical. And then I think the second is, the student debt crisis is a very real thing, and the amount of debt that people have on their personal balance sheets leaving college is significantly higher than 10 years ago, while real wages have really stayed the same. So the value prop for college is just not nearly as strong as it was a decade ago. And it's really quite dramatic. And then I think the third thing is, to your point, there are lots of success cases of entrepreneurs over the last decade. And I think that's become a more prevalent and common part of our culture than it was for a generation prior. And so I think it's really kind of the complex of those three secular shifts that I think are impacting what I think is going to be a highly entrepreneurial generation.
That makes a lot of sense. What's one of your favorite books that's impacted you both personally and professionally?
My favorite business book is The Outsiders. It's written by William Thorndike, and essentially it's an assessment of a number of companies who dramatically outperformed in public markets over the last few decades. And the author draws some conclusions about unique traits that those individuals have that most other CEOs didn't. And I think the key takeaway of the book is that the best CEOs really think about their business from a capital allocation perspective. And I think it's something that is really, really important for our founders to be great stewards of capital. And it's really powerfully written to read through these case studies and see these ties drawn between these very different companies that draws the same conclusion about what made them so successful. And I think it's a really big shift from the way that particularly venture-backed tech founders think, because it does come from this sort of capital allocation perspective rather than sort of a product market perspective. So I think it can really help build a lens for founders. And the second book that sort of I would personally recommend that doesn't have as much to do with business, but certainly there's overlap, is 10% Happier by Dan Harris, which is basically a book about Dan's personal experience building a meditation practice. And I've been meditating now for 6 years. It's had a dramatic impact on me. And I think that one of the challenges with starting a meditation practice is that most of the sources that teach you about it feel very old school or very ritualized, and just harder for a Silicon Valley professional to connect with. Whereas 10% Happier is written by a hard-charging, ambitious journalist, and he puts the language of meditation into a prose and a mentality that is very relatable for the Silicon Valley professional. So I think it's a great, easy read that I would strongly recommend.
That's brilliant. I will definitely have to check both those out. What's one company that you've either invested in or worked with that you're proud of?
Yeah, I just announced our investment in Stockwell last week, which is computer vision enabled retail store, which its first format looks somewhat like a vending machine. What I love about the investment is that we really try to think through what the future of commerce looks like, and we really try to think about what would be defensible and over time and get stronger with time rather than weaker with time, as we see with a lot of consumer companies. And when we thought about the technology differentiation, their ability to build a density of distributed stores, the ability for them to personalize those stores, and how they've leveraged very modern computer vision technology to create a new service, it really felt like something that was special and quite brilliant, and it's been a real privilege to work with Paul and Ash on it.
That's awesome. And what's one company that you should have invested in but didn't?
Oh, I've got too many. Looking back, I did get very close to the founders of Allbirds at the Series A stage, and not only did the company do phenomenally well, but I think Joe and Tim are just phenomenal people that I would love working with, and so you always regret missing out on financial opportunity, but I think the best part of this job is to share the journey with amazing people, and those are two people I really admire and would have loved to have worked with much more closely.
Yeah, I mean, even though you weren't investors, it must still be amazing to watch how successful Allbirds has become. Well, Amit, thanks so much again for coming on the show. I really appreciate you taking the time and sharing your insights.
Great. Yeah, thanks again for having me. I really appreciate it.
And there you have it. It was so great having Amit on our show and share his stories and how he sees the world and opportunities that he sees in early stage consumer. If you want to follow Amit on Twitter, where he tweets a bunch about consumer trends, entrepreneurship, and VC, his Twitter handle is Amit Mukherjee. That's AmitMukherjee. That will also be in the show notes. If you enjoyed the episode, which since you're still listening, hopefully you have, we would love it if you could rate, review, and subscribe on your podcast app. If you have any suggestions on how we can make the podcast better, feel free to send me a DM on Twitter at Mike Gelb. That's MikeGelb. If you want to follow along behind the scenes, you can also follow me on Twitter at Mike Gelb and at ConsumerVC. You are also welcome to check out www.theconsumervc.com, where you can find all episodes. Thank you again, and until next time.